I am Gabriel Penagos, Professor of Finance in the Department of Economics at Pontificia Universidad Javeriana, Bogotá, Colombia, and this is the module of financial markets. Risk is the likelihood that the profit or return on a financial operation will be different from that which is expected. It is not necessarily a negative outcome, it can be a positive one, but results are better than expected. We have limited knowledge on future financial outcomes. They are uncertain. Risk entails a measure of uncertainty regarding the payoffs of an investment. Although we cannot know the future result of an investment, we can list the plausible scenarios and assign a likelihood of occurrence of each one. Suppose we have listed the possible scenarios with their associated interest rates of return and have found the likelihood of occurrence. The expected return is the average of the returns weighted by their probabilities. It is basically an average that assigns greater importance to returns that happen more frequently. It represents what investors would expect from an investment. The expected value is a measure of centrality, but the possible outcomes differ from it, and a measure of this would be useful to assess the quality of the investment. The most basic approach is to take the difference between each outcome and the expected value, and then aggregate the results over the possible scenarios. The drawback is that positive differences will cancel out negative ones, and for a high variable investment the result could be close to zero. The calculations can be improved either by taking the absolute value to each difference or squaring it. The second approach is more appealing from the mathematical point of view, given the tractability of the square function. The weighted average of the sum of square differences is called variance. Its square root, which has the same units as the input data, is called standard deviation or volatility. Volatility increases as the returns spread out. The higher the volatility, the riskier an investment is. It is likely that an investor faced with two alternatives of expected equal returns would choose the one with lower volatility. Conversely, this investor would choose the alternative with the higher expected return if their volatilities were the same. As a baseline to compare investments, it's customary to use the risk-free interest rate from a risk-free asset, an investment the outcome of which is certain. People have different attitudes towards risk. Some are willing to take risks, for example, extreme sports. Others are not that enthusiastic about them. People even pay to avoid risks, for example, buying a car insurance policy so that the insurance company will pay in case of an accident. The cost of an accident is uncertain. When you pay a premium for the insurance, you are effectively transferring the risk. The insurance company will accept the risk if the premium is greater than the expected costs, so they profit from the operation. Suppose you are offered the chance to enter a game that pays 10 if a fairly tossed coin comes up heads and 0 if it comes up tails. Your decision depends on your attitude towards risk. While a risk-neutral investor would pay 5, which is the expected value of the game, a risk-averse one will not accept the game unless the price to do so is less than 5. Incentivizing an adverse investor to take risks requires compensation in the form of an interest rate that is higher than the risk-free rate. That is a risk premium. The riskier the investment, the higher the risk premium. Risks can be classified as idiosyncratic and systematic risks. Idiosyncratic risks affect individual securities or a small group of them. They account for the variability of the price of a specific security. They are related to macroeconomic factors and company particularities. This is also known as unsystematic or unique risks. Systematic, undiversifiable, or market risk affects a segment or all the economy. It incorporates the macroeconomic factors that impact asset classes or an individual asset class. Idiosyncratic risks can be diversified, but systematic risks cannot. One way to control for risk is to build a portfolio, that is, to buy a collection of securities in different economic sectors or classes to avoid exposure to a single risk factor. In setting up the portfolio, we aim to maintain a stable rentability where the negative outcomes are offset by the positive ones. Risks can be hedged by creating a portfolio with negatively correlated securities. When one security does badly, the other does well, smoothing out the rentability. Also, diversification can be achieved by buying securities with unrelated payoffs in order to spread the risk. Suppose that there are two stocks, A and B, in the market, and both cost 100 today. The payoff at the end of the year depends on market conditions. The results are summarized in the following table. Whether to invest in stock A or stock B, the expected payoff will be 115, and the interest rate earned will be 15%. However, the volatility of stock A is 2.72%, and for stock B is 4.08%. Now suppose you invest 60% of your wealth in stock A, and the remaining 40% in stock B. Regardless of the state of the market, the payoff will always be 115 for a return of 15% with 0% volatility. The reason is that when the price of stock A goes down, it is compensated by the increase in the price of stock B, and the other way around. The net result is a stable return with zero risks. Now suppose that the two stocks are independent, therefore the state of each stock does not depend on the other. That stock A is doing well does not imply the same for stock B. There are 9 possibilities. The return is again 15%, but the volatility is 2.45%. If we continue buying uncorrelated stocks, the risk will fall as we add independent sources of risk.